we've got some numbers on gold and silver that are not far above the current market. That if you go there, we think that the issue about which way is this going to reconcile is going to resolve quickly upside. If you hit the numbers I just mentioned above the market, I think you can seal it off. That the downside efforts have failed. They've done all they can do, and we're now going to re-engage to the upside.
This week's specials with Miles Franklin Precious Metal Investments. Type 2 American Silver Eagles for only $7.75 over spot, and 2-ounce mother and baby platypus coins from the Perth Mint for only $3.75 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you. Our interviews we've done with you have been some of the most popular we have ever done. So it's great to have you back. And also this time again, we asked viewers to submit questions. They range from gold, silver, the stock market, and also platinum and palladium. So we'll get your perspectives on all of those today. If you want to just start out with an update on precious metals, if we look back, we just ended the third quarter of the year. Where do we stand right now? And can you explain for our viewers once again your unique way of analyzing the precious metal markets, looking at the momentum?
Well, instead of looking just at price, which everybody looks at, which sometimes can tease you, because first off, everybody sees it. And everybody therefore might see an obvious breakout one way or the other on a price chart. It may or may not be valid, but oftentimes when there's a consensus about something, it doesn't work, okay? We look at momentum because to some extent that detaches our analysis away from the fiat currency by which everyone else is measuring an asset. And we know that fiat currency, in our case, the dollar, is changing dramatically, even on a short period of time, in terms of its real intrinsic value. It used to be every decade since 1959. The money supply almost doubled every decade. So, that's a huge degradation. But now we're on a very high speed rate of degradation of the money unit, meaning quantification of the money unit. Same is true with the euro and the yen, so forth. So these yardsticks that people use to measure things are rubber yardsticks. And so to detach ourselves from the price chart, which is to say move a bit away from the fiat currency unit of measure, we measure the action of the market in relation to certain moving averages. How much above, how much below that given average, and we oscillate it like an oscillator. That to some extent separates us partially from using the fiat currency as our yardstick, because it sets a new yardstick that's partly based on the dynamics of the asset itself. In other words, how fast is that moving average rising or falling? That depends on the price action. But it's a step away from just using nominal price. Okay, that was confusing enough. All right. But when we look at our momentum charts, we're looking essentially at the same thing that the price chart folks look at, and that is trends. Uptrend lines, downtrend lines, floors, ceilings, the whole deal. Except we see them on momentum. Usually momentum will make a trend change before price will. So we have a heads up that, something's going on here. And or another situation is if you get a breakout on price, but you don't get a breakout on momentum, beware. It could be a false price signal. And so that also assists us. So right now, when we look at a gold and silver chart, what you have is a lot of confusion on the price charts. It was pretty clear it's 9 months involved. You dropped from your August 2020 high in gold, and you worked yourself down to the March low at 1673. And since then, we've been caught in a range, gold has, generally at that low. It retested it quickly in early August in the nighttime selling that occurred one night in the electronic market. But basically, you've been oscillating either side of 1750 to 1850 since that March low. It was our assumption when the March low occurred, and that was a 20% correction. It took them 9 months to get that 20% correction. that was probably the low. And yes, we've had some selling pressure back toward that level a couple times over the last several months, especially since the Fed taper talk began mid-June. That sharp sell-off in early August in the nighttime session, et cetera, et cetera. You generally wrapped around the notion that the Fed's going to somehow change everything the other way, as if. Okay. I think the markets digested that pretty well, fundamentally, and sort of said, I don't know. Because if it really believed that it should be continuing to collapse, so should a lot of markets, frankly, including the stock market. So I think to some extent that's baked into the cake in terms of possible policy change by the Fed, but it's very incremental. And we suspect, based on the vulnerable look of, for instance, the US stock market, in terms of starting a decline that would upset the Fed and upset a lot of people, that is a factor that must be watched. If you're watching gold, watch the stock market, because if it starts to go down, that's going to put pressure on the Fed to not taper or to reverse a tapering policy. So we think that's a very important thing to look at, even if you're not involved in the stock market. We've got some numbers on gold and silver that are not far above the current market. That if you go there, we think that the issue about which way is this going to reconcile is going to resolve quickly upside. And without getting too specific, because the numbers do change over time, each month they might adjust a bit, so forth. And also, our subscribers pay for that service, so we don't want to give it away for free. But I can tell you that less than $1 above where silver is right now. Silver is about $22.60, $22.70. Less than $1 above that level, you're going to start to engage some momentum factors to the upside, which will indicate to us that, okay, that downside pressure we just saw in silver, which nipped out the September 2020 low. And remember, 6 weeks after the high in August of 2020, silver dropped from near 30 down to under 22. And then it popped back up and lived above that $22 level all during that time until a few weeks ago when it went down and nipped out 22, got to like 21.50, just enough to say, okay, I broke down. Now we've popped back up into the range. The question is, when you look at a price chart, where do you get bullish? Well, you look at the price chart and say, well, you have to go back to 30 or something before you start to emerge on price. But we're arguing that starting in the mid-23s, silver is telling us that it wants to re-engage back up to the upside. For gold, the numbers in the 1820s. Okay, we've got a couple numbers up there that if you get there, it says, okay, we're coming out of this trading range. So right now, if you're watching gold, just sit back and watch. Don't add to your position until you see these numbers engaged. And if you're not in the gold market for any reason, then wait for those numbers to be engaged on silver and gold, and then say, okay, lights turn green again.
Definitely. And as you mentioned regarding silver, we actually have a viewer's question on this. They're wanting to know regarding the recent pullback we've seen. Some people have been saying, well, it could fall lower. We could go below $20. Your perspective on that. The specific question is, how likely is it that silver will drop below $20 before it goes to 50?
I think it's less than likely. I think they had their chance the last few weeks of selling in gold and silver to go ahead and get it done. In other words, let's break below the March lows in gold, 1673. Let's collapse down and head toward the 3-year average, which is in the lower 1500s. Okay? They've had plenty of shots to do it. They've had plenty of time to do it, and they can't seem to get it done. That March low is still holding up. And silver finally went down and did make a lower low than it had at any point in the last 14 months. Did it by 50 cents and immediately popped back into the range again. So we think that was sort of a failed effort by the price chartists to get something going on the downside. I won't say they totally failed, but if you hit the numbers I just mentioned above the market, I think you could seal it off, that the downside efforts have failed. They've done all they can do, and we're now going to re-engage to the upside.
And with regard to gold as well, then, this viewer is wanting to know, do you think that gold will hit all-time highs this year, or would that be next year?
If you engage those numbers this month, probably this year. But I would think within a few months of engaging the numbers that we've got above the market, again, which aren't that far above, that you could go to new highs within a couple months. It was pretty rapidly. You could just sweep back up through the price range we've been in for 14 months and go back and prove to the price folks, hey, this thing really is alive. Of course, that's going to require gold getting up back to 2,000 area, for example, and gold on the price charts, that is, and silver getting back up close to 30. Our numbers are well below there in terms of confidence that it's going to re-engage out of this, what in effect is a large congestion zone.
Now, Jonathan is wanting to know, what will be the catalyst that will push gold and silver to those explosive moves that you have been talking about?
I think gold in particular, and silver as the daughter metal. I'm speaking now of monetary metals, not just precious. Okay, we separate this from platinum, for example. It's a precious metal, but it's not a monetary metal. We think that rather than needing catalysts, that gold leads the catalysts. In other words, it is a long-term way to protect your assets. It always has been, always will be. And what we're engaged in now is already enough to justify a lot higher gold prices. It's simply the degradation, ongoing degradation of fiat currencies. And it's not just one country. It's not Japan was doing a heck of a good job of doing that the past few years, and now Europe and the US are doing it full throttle as well. So there's your catalyst. It's ongoing. And to think that that's not going to continue is probably a great error. Again, partly because certain assets are very vulnerable, key assets in the mind of the Fed, in the minds of most people, the stock market. If that becomes a doubtable asset category, where you drop 7, 8, 10% off the high in the S&P, for example, doubt's going to sweep into the market again about, is this a safe place to be? And suddenly the Fed will need to defend that category, because if that category turns down, and I don't mean collapses, but turns into a bear, a normal bear, which is a ratcheting downside process, they're going to have problems, because that's one of the few positives that they've had out there going for them. So they'll have to quickly rephrase their policy and cease to taper and do something else even more aggressive, probably. So I don't think gold needs the catalyst. It didn't need, think about it this way. 2015 low, gold had about a 50% pullback from its 2011 high. Okay, it wasn't quite 50%, I don't think. It turned up from the 2015 low, built a trading range above that low for the next several years. In other words, never went back down to 1,054 again, without any particular fundamental that we now see in play existing, except just simply the ongoing degradation of the money unit. Then in 2018, I think it took out the price chart range that we'd been in for several years, 2019 probably. Momentum had already broken out before that. Gold did all this without a weak dollar, without any inflation showing up in commodities whatsoever. In fact, commodities were still laying on their back in a 5-year base, hardly breathing, looking at Bloomberg Commodity Index, for example. Yet gold went to 2,070 in August of last year from a low at 1054. So it doubled in price without any particular factor coming into play. Most of the factors that we now see, like the commodity upside, came in after that event. It had already doubled in price without having to have a catalyst. So I think looking for a specific catalyst, in some markets that might be important, but I think in the case of gold, it's the mama market of all. It's ahead of the catalyst. It knows the ongoing trend of statism, which is to manipulate money, manipulate interest rates, and it knows the negative effects of that in the long run.
That's very interesting. I've heard in the past that really gold doesn't necessarily react to inflation. It anticipates inflation. So gold will rise before we see inflation. And that's really what we've seen is gold rose, and now we are starting to see the inflation. Your perspective on that kind of gold being a leading indicator, it seems like.
Yeah, definitely. It led by several years before the Bloomberg woke up. And it's still just waking up. I think there's a lot more room there in the Bloomberg. But gold anticipated that event. If you waited for the commodity upturn, gold had already doubled. You missed the move. If you wait for a dollar collapse, the dollar hasn't collapsed. It's gone to sleep, well off its recent highs a couple of years ago, but still it's gone to sleep. And gold has doubled in price We didn't see a commensurate opposite move in the dollar. So find me the catalyst that explains that move. Now we see it after the fact. And I don't think gold's looking at those particular events either, nor is it paying too much attention to what Powell says, assuming he's even going to be the head of the Fed in 4 months. That's a big if, especially if the stock market gets wobbly, because Biden's got enough problems as a public opinion. All he needs now is the stock market to start to get wobbly because the Fed's tightening. Okay? I think he'll start listening to Senator Warren if the stock market starts to break. And she's on a crusade to get Powell out of there and get that lady in there who wants to print. So anyway, gold anticipates, yes.
Now, with respect to mining stocks, we have a viewer's question on that. Your perspective on the mining stocks going into the end of the year?
I think they've probably seen their low as well. They went down, stomped out the lows of the range that we'd had since March. The ETFs like GDXJ, SILJ, the junior miners already took out that March low that they made commensurate with gold made its low. GDX didn't do that until just the last several weeks, finally went down and nipped out the March low. I mean, it's a big price chart number that everybody's looking at. We think they're vastly undervalued, and I'm not going to put input on fundamentals. A lot of fundamentalists that I know of consider probably the most undervalued asset category out there in terms of their earnings and the price of gold. I mean, think of these miners. They've become a lot more efficient in the last 5 or 6 years because of that last bear market we had in gold. And now gold, instead of being $1,100, $1,200, $1,300, is hovering where? Either side of $1,800. Their profit margins have just exploded. Even if it's off the high, it's still at a very high price versus 3 or 4 years ago. We think the miners will slingshot if we engage those numbers in gold and silver that I mentioned. We think the miners will slingshot back to the upside at a faster pace than gold turns up. So they're sort of like a yo-yo. You don't want them when you're pulling back. You want them when you're going back up. And we think the miners are probably the best place to be watching now. If gold and silver engage our positive numbers just overhead, it's go to the miners instead. We think they'll come out of the hole more rapidly.
And as we see this move in gold and silver, what are you expecting for platinum and palladium?
I separate those two. Platinum is behaving much like a general commodity. In fact, you can almost overlay a price chart of platinum on top of a crude oil chart or a corn chart or a Bloomberg commodity index. It hasn't behaved like gold. It didn't bottom in 2015 like gold. And I would treat it simply as a precious metal, as a metal. In other words, it's moving with the broad commodity category. And basically, you could throw a dart at a commodity chart, a cotton chart, a live cattle chart. And they're all doing about the same thing. And that's a reflection of largely monetary policy. Finally, money is seeking a place that's lower risk than something that's been going up for a dozen years vertically, stock market. Commodities have been going down to 2015 and then laid in the weeds for 5, 6 years. Now they've come to life again. So they're far less risk, probably a lot more reward, and a lot of asset managers realize that. So platinum is part of that group. Don't treat it like gold. Palladium is a totally different thing. We commented on palladium several months back, as I recall, and we don't report on it very often. And we said, do not treat this even as a precious metal. This is an industrial metal. And if the auto industry gets into trouble, which they're in now because of the chip problem and their production level is dropping, because they can't make as many cars. Therefore, the amount of palladium used in catalytic converters is dropping, the quantity needed. So that's no doubt hurting palladium. Palladium should be treated separately on its own merits, not linked to gold or even to the commodity category. It's one commodity I distrust right now among the broader categories.
Now, with respect to the stock market, if you could expand on that, you mentioned how if the stock market does turn down, that would kind of put pressure on the Fed to not taper. Can you expand on kind of where you see the stock market heading into the end of the year?
We made a high on the S&P 500 now, and it's not the leader index. The leader index to watch is NASDAQ 100 because it contains the heaviest weighted symbols that have led the stock market up. They're also heavily weighted in this S&P 500. I'm talking Microsoft, Apple, Amazon, Google, and even Facebook. Those are heavily percent weighted symbols within the NASDAQ 100, and they're also moderately heavily weighted in the S&P. So when you look at those 5 symbols, they constitute a large percentage of the gains we've seen in NASDAQ 100 and a moderately large percentage of what we've seen gains in the S&P 500. So if those 5 guys turn down, and we're monitoring each of those as well, we think you got a problem because they're not going to be replaced by something else. You might want to fantasize about that, but don't. The leadership, if it turns down, it's over. So we're watching the NASDAQ 100, and we've got very specific numbers below the market that, frankly, we got within about 2.5% reaching in the sell-off low we've just seen. Now, we're rebounding in NASDAQ right now. S&P, same story. We had a number specified in our last weekend report that was a couple percent below where we closed out last week, and they dove like a bomber down toward that number this week, got within 4 S&P points of their trigger number, turned around. So we know our numbers are valid because the market's behaving like, oh, if I hit that number, I'm in trouble. So they're trying to avoid those numbers. We don't think they'll ultimately be able to avoid the numbers. If they engage those numbers, we think the top is in place. Now then becomes an issue of, well, what kind of decline are we talking about? We think once the market has topped, and we think it's topping, but we don't declare it having topped yet until our numbers break. We're very number specific. But once the market tops, we suspect a normal bear market will evolve, meaning a ratcheting downside, not beginning with a crash. The only bear market in U.S. history that ever began with a crash was 1929. Most other bear market, 2000 top, 2007, if you go back and look at the charts, it was an arm wrestling match. You shed 10, 15%, rally 5, 6, 7%. It confuses people. That's the kind of bear we're looking for. But we know that there's enough public sensibility and asset manager sensibility about suspicion about the stock market based on various fundamentals that everybody looks at, valuation factors, so forth, that if it wobbled 5, 6, 7% off the high, doubt would increase. And it would also, the Fed's doubt would increase as well about the safety of that asset category in terms of being a negative factor for public sentiment, public consumer consumption, and so forth. And frankly, we think the market's topping, but it's an irregular process, and it's going to be confusing. And once we hit our numbers, we'll say, okay, we think it's topped. We haven't hit them yet, but they're not far below the recent lows.
Now, you mentioned how the stock market is going to have probably a fall, but not a crash immediately. Before like a crash, it seems like you'd normally have like a blow off top, but it doesn't seem like we've really had a blow off top. We've just continued to see the rising prices or the stock market continue to rise and kind of just level off now. We're not seeing that blow off top. Is that the reason we're not going to see a crash?
I'll take the other side of that. I know there's a lot of people right now talking about a blow-off occurring. In other words, another phase of verticality before the market tops. We think it had its blow-off. And we measure it 2 different ways. One, price itself. If you'll take a NASDAQ 100 chart, go back 10 years. Get an S&P 500 chart, go back about a decade. There was an angle of ascent. It was pretty steep, not vertical, but nice, choppy, but a nice angle of rise that persisted for several years. And you can, in fact, draw a line across prior highs, not under the lows, across the highs now, the angle of ascent. Last summer, NASDAQ 100 went through that line and shot vertically up from last summer till late last year. Big percent gain, much more rapid than any other phase in the bull market. S&P also had its own version of that, where it accelerated above the angle of ascent. So on price itself, we call that a blow-off. Now, then when we run momentum charts of the S&P 500 and the NASDAQ 100, annual momentum, so we measure the monthly price bars in relation to a 36-month average. What you see is this. I'll try to visually explain. After our bear market low in 2009, which was for the S&P was 40% under the 36-month average, you shot up, and every single rally high measured against that moving average, how much percent above that 36-month average, for 5 or 6 years, reached the same flat level. Price was continuing up, momentum was hitting a ceiling. Last summer, you punched through the top of that ceiling on momentum, coincident with price going above its acceleration line. So momentum also said on NASDAQ and S&P that it was engaging in a, quote, blow-off phase, where it accelerated the momentum readings to very high levels. So we argue that, no, you've seen the blow-off. The issue now is, when does that blow-off abort? That's the phrase we use. You abort the mission, okay, exclamation point. We measure that when momentum falls back through that ceiling that it had developed on the S&P 500 and on the NASDAQ 100. It's a flat ceiling. On the NASDAQ 100, in fact, it goes back a decade. The same level on 40% over on NASDAQ 100 is where all the highs occurred until last year. We went up to 60% over. So the issue is, if we fall back on momentum and drop back to that 40% over level and close a month, then what you're doing is like the elevator going through the top of the building, and that's coming back down through the top of the building. Okay, that's our failure point. S&P has a similar structural failure point on momentum. We approached those numbers at this month's low, but didn't get to them. So it wouldn't take a lot below the lows we've just seen to cause both of those annual momentum charts to abort back through their old ceilings. Once you do that, it's a free fall to the next support level, which is a fairly decent percent, but it's not a crash dimension. But that's what we're looking for. I hope I described that clearly enough. So we argue you've seen a blow-off. We're looking now for the abort of the blow-off to declare a top.
Yeah, I think that is very clear. And your perspective is that the Fed really won't be able to prevent this downturn?
I don't think so. There's a point at which asset managers and investors themselves, especially asset managers who run multi-billion-dollar funds, have been around long enough and remember what happened the last time around and the time around before that, that there's a point at which you've got to become skeptical. Too many things are excessive, and therefore you're ready and willing to transfer some assets from that category to another category. And we already think this is underway to some extent. And it's evidenced by the rise in commodities and commodity-related stocks. You know, you look at a XLE ETF, which is the oil sector ETF, and compare it to the S&P 500. There's no correlation at all, hardly. From 2011 onward, the XLE went down, while the S&P went up. Okay, it was like opposite charts. Now, XLE and a lot of commodity-related stock sectors have turned up, and freshly so. And there's still some of them at very cheap levels historically. So it's evidence to us that somebody out there, large asset managers in particular, I could probably name a couple, but I'm not going to, you know who they are, and they're not gold bugs, have said, okay, I'm going to move some assets over to this less risky category that has probably more reward and move it out of that category. No, they're not dumping all their stocks. They can't do that. They're competing with other asset managers. And if they're wrong, they get hurt on a relative performance basis. But they're already starting to move some of that money over, and you can see it evident in the commodity charts, commodity stock charts. And we think that's the beginning evidence of an asset class shift. So once you get a tipping point, and we think our momentum abort levels would be that tipping point, then you're going to have more and more asset class shift, regardless of the so-called fundamentals of the stock market. It's an issue of pricing and age. You've gone up for a dozen years, you've gone vertical, and the monetary policy has no doubt helped that. And even if it continues, it won't necessarily flow, that money won't necessarily flow into the same category, as reflected by what happened in the late 1970s. A lot of monetary expansion didn't help the stock market. It was dead land, wasteland till 1982 before it engaged again, or commodities took over. So we think that's how it could work out. So we're watching that evidence of that asset class shift.
Fantastic. Well, it'll be definitely interesting to continue to track everything that's happening. And Michael Oliver, we really appreciate your time today. Before we let you go, where can our viewers find you online if they're interested in learning more? And any last thoughts you'd like to add?
Okay, our website is olivermsa.com, MSA for Momentum Structural Analysis. And request a sample, and there's a lot of information on the site about our methodology, our history, and so forth. But as far as what to watch, we're suspecting that the rally in the stock market right now could get up, approach, but probably not take out the highs we made, I think it was in August. On the S&P 500, it was 4550 area. I think you might get up to the high 4400s. Everybody will feel good again. But if you ever roll back after the rally we're now in, roll back down probably even under 4,300 again, the market's not going to hold that next sell-off, and our numbers will probably engage at that point. So right now, let them rally. We think it's probably in the topping process, and we think that is a big variable that will affect all the things we've been talking about, like further asset class shift into commodity related and into gold and gold miners, for example. So even if you're not in the stock market, watch it, because we think it's a heavily influential factor for Fed policy and for public sentiment.
Fantastic. Once again, Michael Oliver from olivermsa.com, Momentum Structural Analysis. Thank you so much for your time, and God bless.
Thank you, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.